Well, let's get first management and talk a little bit about the outlook on the bond market post the recent reforms with CARE ratings, as well as the growth outlook. With the management, we have Rajesh Mokashi. He's the Managing Director and CEO, now joining in on the show. Thanks very much for taking the time out. Now, there have been recent reforms like, the dual ratings for the IBC IBC, the dual ratings for CPs. And the government is considering A-rated bonds for investments as well. I just want to understand how positive this is for the ratings industry.
I think these are very good reforms for the rating industry, and we ourselves have seen a reasonably uptick taking place in the rating revenues last year as a result of the CP in a dual rating business. There is this resolution plan ratings, which are also dual ratings in some cases beyond a certain size. We have this finance minister mentioning in the last year's budget that he would encourage even investments to be made by the provident funds and insurance companies for A- and above rated paper. Now, this will translate into better rating revenues for us. And right now the CPs and IBCs are already having their impact in terms of rating revenues. But the impact of this A- revenues will come in once the IBC also track record gets established in a better manner, and that would really pick up, make sure that the ratings of A- and even below rated papers to be subscribed by various institutional investors. So I cannot attribute a single number to it, but these are all upsides to the rating activity. The bread and butter rating revenues come from credit offtake growth and bond volumes growth, which also have grown up reasonably last year. And going forward, the transformation in the bond markets towards structurally from bank loans to the capital markets taking place in a very healthy manner. And IBC is going to help us shift towards the bond markets much faster than many other markets.
Right now, the FY18 ratings revenue, that was up about 15%, a little bit lackluster. However, the debt ratings were strong. That came in higher by about 25%. How much do you see your revenue growing in FY19 and the revenue for debt ratings?
No, I think, if we are to see the rating revenues in the context of the underlying credit growth and how does the competition fare? We have grown the best amongst the two other listed companies. So we have done better than them. So I would say that 15% growth on a unadjusted basis is an outstanding growth rate in the current state of credit markets growth rate, which were roughly less than 10%. So I think, within that framework, I thought we have done outstandingly well. And going forward, again, depending on the credit offtake growth, which I assume to be roughly in the region of 10% and more, we should be able to do well.
How do you see SME sales and ratings business growing for FY19-20, and tell us what would be the key growth drivers here?
See, the SME business was affected last year because the subsidies were no longer there for the NSIC schemes. And because of that, we had to really refocus our SME business on so-called small ticket Basel II loans. And last year, we did continue with our emphasis on this market, and despite this NSIC business coming down substantially, we still more or less managed to hold on to the piece of SME business last year, and that our focus will continue to be there this year, and this year we expect to further grow this business. This is a highly under-tapped market in the sense that the whole industry could have not rated more than 1 lakh entities, whereas there are more than 50 million SMEs in this country, and that offers a huge opportunity for rating by rating companies like CARE, and we intend to remain focused and increase our penetration on SME ratings in India.
So what is the growth strategy? What are going to be your key focus areas in order to improve your profitability over the next 1 to 2 years? Are there any revenue diversification plans going ahead?
I think we are a large full-service credit rating agency, and we like to stick to the basics of our rating business, where our large corporate business and small corporate business are the two big drivers of ratings. And we will continue to focus on the bond and the loan market and the SME markets, which I mentioned earlier. Apart from that, we have a few subsidiaries which are focused on risk solutions and advisory services and training and research. So they will try and add their own growth, revenues in the non-rating space going forward. Last year, we have roughly around 10 crore of non-rating business, which is negligible compared to the size of this company. And over the next couple of years, our non-rating business will tend to increase as the subsidiaries start scaling up and growing much faster. Otherwise, the main company's focus will remain on the bread and butter rating business, which is bonds and loans, and will be driven by the underlying volume growth in this sector.
All right, we'll let you go on that note. Thanks very much for joining in and giving us a view of what's going on in terms of the macros, the implications on the credit rating industry as a whole, as well as for your company as well.